Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend. Today we will be doing technical analysis on the S&P 500 for Monday, March 9th, 2020. And for our charting service, we will be using stockcharts.com, which is a service I pay for, and I will leave a link to their website in the description box below this video. The first thing I want to point out here is we were down 7.59% today on the S&P 500, making it the worst day in the S&P 500 since 2011. We finished the day at 2746.70 and, of course, breached some key support levels on the way. As you may remember, 2855 had been the lowest point we had touched in this downturn since we peaked back on Wednesday, February 19th, where we closed at 3386.15, which to this point is the all-time high in the S&P 500. Now, this chart that we're looking at is just a one-month chart, and each candlestick represents one day in the S&P 500. I wanted to really focus in on this month to start with and just use daily candlesticks so we can really tell what has happened. So obviously, peak in the market here, and you can see where we've been. Hit that 2855.84 low on Friday the 28th. Had a halfway decent week last week. Actually was up 0.6%, 0.61% to be exact. And then, obviously, today, fell down and had a very bad day, down 7.59%, and again, closed at 2746.70. So, some key areas that we need to keep an eye on here, and now we're going to go back to an 18-month chart where each candlestick is 1 day of trading. And you can see here, again, the 2855 level that had been pretty important because not only was it the lowest level that we had hit up to this point, up till today, in this downturn, but it was a level that we had hit in October of 19. It was the lowest level we had seen in October of 19, and you can see that there was quite a bit of trading around that 2855 level back in August of 2019 as well. So the fact that we're now below that is significant. And this 2750 area is super important here, guys, on numerous levels, and you'll see that as we go through and look at the balance of these charts. So, we're 2746.70 is where we closed. It's not significantly under 2750, so we might get a pop back from here, but I wouldn't count on it. It really feels like we're in a negative feedback loop, guys. This is starting to feel a lot like 2000 through 03 and also 2007 through 2009 to me, where we're starting to experience the domino effect, and we're starting to see one domino after another fall. And I wouldn't try to be a hero here, guys. So these are really, really dangerous markets. It's just not worth trying to be a hero here. I think you're much better off being in cash, sitting on the sidelines, keeping your powder dry. There will be tremendous opportunities on the backside of this thing, but it really looks like we're going to go lower from here. So this 2750 area where we closed today, again, we're slightly under it, but we're close enough that, could it pop back, at least in the short term like it did here? You can see that we hit this just slightly below this 2750 area, kind of went down and kissed that 2725 area on the S&P 500 back in June of 2019, did a very similar thing back in March of 2019. So we're right there at another key level where, is it possible after a massive down day like today that we'll get a little bit of a snap back? It's absolutely possible. But the likelihood of this situation improving itself from here is very low, okay? So, again, just be careful, but don't be surprised if we get a little bit of a bounce over the next few days after a massive, massive down day like today. It could definitely happen, but I think it would just be a recoil after potentially being slightly oversold in the short term. I wouldn't think that any positive activity in the markets over the next couple of days means that the low has been put in. I just don't see it that way at this point. So if we do break this 2750 area, we really need to keep an eye on this 2700 level, because anything below this, and we're technically in a bear market. Actually, the exact number on the S&P 500 would be any close below 2007.8.94. Again, 2708.94. That is where we hit 20% below our all-time closing high of 3386.15. So anything below 2708.94 on the S&P 500, and we're in a bear market. So I just drew the line at 2700 to make it easier to remember. It's a lot easier to remember 2700 than 2708.94. But anything below that, we're in a bear market. And then down here on this 2350 level, this would be where we started this rally, if you will, that started at the end of 2018. So this is where we bottomed in 2018. And so this entire move that we've had from the end of 2018 until February 19th, that's the entire move now, okay? And so if we retrace 100% of this movement, it would take us back to 2350 on the S&P 500. And we can see this again, and we're going to look at this in a couple more charts. But what we're looking at now is a 2.5-year chart where each candlestick represents a week. So I think it's good to look at this in a different time frames. But again, you can see the importance of this 2750 level. It acted as support back in May and June of 2019. We had some trading right around that area in February and March of 2019. But the other, I think, probably most significant thing is the first time we ever got above 2750 on the S&P 500 was the first part of January 2018. So at this point, we have now erased all of our forward progress in the S&P 500 since the beginning of 2018. So, guys, I mean, we're basically kind of back where we were at the end of 2017 is what I'm trying to say here. So, we've definitely given back all of our profits for the last 2.25 years, and we're now experiencing psychological and portfolio damage at 2750. And again, anything under 2708.94, we're in a bear market, and of course anything under 2700, just the easiest way to remember it, we're going to continue to experience more psychological and portfolio damage at those levels. But I really do think that 2350 at a bare minimum is what we see before the damage is over on this correction. Now, it could get a lot worse than that, guys. These markets could continue to fall longer and farther than most people think. I'm not trying to be overly dramatic. It's just I've been at this a while, and it's just starting to feel that way, unfortunately. Now, what we're looking at here is Fibonacci retracements, again, of this move that we saw from the end of 2018 through where we peaked on February 19th. And another reason why this 2750 area, right, we're close enough to it, we just closed a few points below it, but this 2750 area is so important is we have now given up 61.8% of this entire move. And you can see that basically I'd already drawn these Fibonacci retracement numbers before the market closed, but you can see that we finished pretty much dead on the 61.8% retracement of the prior move, which again, the move was from the end of December of 18 where we started, and then where we finished up at the peak on February 19th. So we have now erased 61.8% of all of that gain, and to think that we can't, retrace the other 38.2% and get back down to this 2345, 2350 level, I think is to be naive. And I don't see anything that is going to stop this thing from going there. Now, again, might we get a few positive days from here? Totally possible. But again, this is just another reason why this 2750 level is so important. And again, you can see that it lined up, very, very well with where we were at in May, June, and then back in March. And then here's another way to look at this. Now, I just did Fibonacci retracements on the entire bull market that started March 9th of 09, if you can see where my cursor is moving. So now we are on a monthly chart. So each candlestick represents a month of trading in the S&P 500, and this chart goes back to 2008. So if you can see where my cursor is moving in the lower left-hand corner of the chart, that is March 9th of 09 when we bottomed. And so I drew the lines from that starting point until our peak, where we peaked in trading. Not where we closed, but where we peaked in trading is how I'm drawing these lines. But there's multiple ways to do this, right? But this is going to get us close enough. But again, what you can see here, again, using Fibonacci retracements, the key numbers for charting are 38.2% and 61.8%. And you can see here that a 2350 area, this area, if we pull back to that 2350 area, that represents a 38.2% retracement of this entire move, which again represents up to this point the entire bull market that started March 9th of 09. Now, was February 19th of 2020 the end of the entire bull market? There's no way to know at this point. Is it possible? Absolutely. Is it starting to feel like it may be highly possible that marks the peak of this particular bull market? It's starting to look that way, guys. It's really starting to look that way. So, yeah, again, this is why I think at the very least we're going to see 2350, somewhere around 2350. And again, you can see where we touched this area back at the end of 18. But at the very least, I think we're going to see 2350 on the S&P 500. And even though a 50% retracement of a move is not a true Fibonacci number, it is a very normal technical retracement. And you can see here that if we retrace 50% of the bull market before this correction, this downturn and or bear market, as it may end up being, is over, that would take us down to at least the 2100 level. And you can see there's a lot of trading in that area during at the latter part of 2014 into 15 and into 16. So 2015, we pretty much traded around that 2100, 2000 to 2100 level. So again, I'm not trying to be dramatic here, guys, but at this point, we would be naive to think that we couldn't see a retracement down to at least 2350, if not 2100. And guys, it could get worse than that, okay? So I'll stop there on this particular video. But again, don't try to be a hero. Don't think it can't get worse from here, because it definitely can. And, I was working in financial services during the 2003 downturn, through the 07 and 09 downturn. I know what it feels like, and I'm telling you, it is starting to feel this particular situation that we're in now, with being in a negative feedback loop and starting to see these dominoes fall. And it is really starting to, and once you get into one of these situations like this, it seems like it's just so hard to get out of it. I mean, think of it kind of like a fire, okay, forest fire, whatever. And once it gets started, it's so hard to stop it, and you pretty much have to let it burn itself out. And unfortunately, I think, and I hope I'm wrong, guys, I hope some piece of good news comes out of here and, and stops the downturn soon. But it really feels like kind of a major forest fire that we're experiencing here, where it pretty much has to burn itself out. And unfortunately, that means that, there's a lot more damage to be done in the stock market. So, it's not too late to take profits, go to cash, reduce your equity exposure, protect your portfolio, because, again, it could get a whole lot worse from here. Thank you for being on this video with me. If you haven't already subscribed, please subscribe to my YouTube channel. Give me a thumbs up on this video, and I'll see you tomorrow.